Can the 30-year mortgage interest rate go up to 18% again? And what happens if it does? These are scary days in the market. Interest rates have doubled since January. How have we been affected in Baldwin County? Well, it's like someone threw a wet blanket over us. Our local market is reacting with fewer sales, more inventory, and larger numbers of price reductions. The good news is that while home prices are softening, they're not dropping a big hurry like some parts of the country. There are some great deals to be had on new homes. Builders are stuck with homes that were sold to buyers who no longer qualify for monthly payment at the higher interest rates. The builders can't cut the prices on the homes because that would affect the other homes under construction. So they're offering incentives covering closing costs and mortgage interest rate buy-downs. With the midterm elections just having occurred, the news has been full of inflation coverage. Republicans were blaming the Democrats for inflation and saying, elect them to fix inflation. Democrats pointed to job growth and said the economy is strong and inflation will be coming down. But mostly, we want to talk about something else. In my opinion, the politicians of both parties aren't physically responsible. They come in two flavors, tax and spend, tax cuts and spend, with spending being the common denominator. They both promise, elect me to fix inflation. And the joke is on us because elected officials of neither party can fix inflation. That job belongs to the Federal Reserve Bank, the Fed. The Federal Reserve was created in 1913 to serve as the nation's central bank. The Fed consists of 12 regional Federal Reserve Banks. The heads of each Federal Reserve Bank are appointed by the president to staggered 10-year terms. They make up the Fed's Board of Governors. The 12 Federal Reserve Bank heads and a chairman, also appointed by the president, meet and determine fiscal monetary policy, independently of elected political officials. So how does the Fed implement the monetary policy? Well, banks are required to maintain funds with the Feds. The banks borrow back from the Feds these same funds to lend, and when inflation gets too high, the Fed increases the rate it charges banks. Banks raise their rates. Businesses and consumers react to the rising rates by borrowing less, which slows the economy and lowers inflation. Mortgage rates are not directly linked to the Fed rate, but they do react to its changes. A look at countries worldwide shows that rising inflation is a global phenomenon and not unique to the United States. U.S. inflation is currently 8%, UK inflation is at 9%, and European Union inflation is at 10%. This fact argues strongly that high inflation in the U.S. has not been driven by any unique American policy, not the American Rescue Plan and other generous fiscal relief during the pandemic recession and recovery, nor anything else U.S.-centric. Rather than the specific policies of the Biden administration driving inflation, the roots today's inflation are more complicated cocktail of other forces, from the spike in raw material, energy, and commodities prices, due in large part to the Russian invasion of Ukraine, to lingering supply chain disruptions and distorted consumer demand patterns stemming from the pandemic. These shocks and their unexpectedly large ripple effects are the global explanation for rising inflation. And if you will permit me, a soapbox moment. I think greed has a lot to do with it. COVID distracted us, and while we weren't looking, a lot of companies took advantage of the chaos and raised prices. Before COVID, a 12-pack of canned Cokes cost about $5.50 at Publix. Today it's priced at $8.50, a 55% increase for flavored bubbly water. There's no way the cost went up 55%. Somebody, Coke or Publix, took advantage of the situation and stuck it to us. Cereal's still in the same size box, but now it's only 3/4 full. Airline tickets for this Thanksgiving are 3 times as expensive as in 2019. I bought a new pickup in 2019 for $58,000. The same truck today sells for $77,000, up 33%. Again and again, we find examples of corporate greed taking advantage of consumers. Hey, I'm all about free enterprise. But hey, give me a break. At the first of 2022, the Fed announced it couldn't live with 8% inflation. It was going to raise the rate and charge banks until it got the core inflation back to 2%. And that's exactly what they're doing. They have raised their rates 6 times so far in 2022, including the latest 0.75% on November 2nd. So the $64,000 question is, how far up will rates go? Let me tell you a story. I have a good friend who decided to open a plastic pipe manufacturing plant in 1979. He was able to finance his equipment at 8% when inflation was running at about 9%. Now, he had been a successful corporate executive with a strong financial background. Housing starts were strong and seemed to be the perfect time to open a plastic pipe plant. But then the Fed decided to put the brakes on inflation when inflation was about where it is today. Over the next 2 years, the Fed increased its rate in increments until the Fed rate was at 21.5% and the 30-year mortgages peaked at 18%. The housing entries came to a screeching halt. All housing construction stopped. And my friend went in a heartbeat from a smart, very wealthy entrepreneur to much wiser, broke employee. And everyone else serving the housing industry also saw their dreams turn to dust. Will history repeat itself? Well, it's certainly setting itself up. So, probably. Will we see 30-year mortgage rates at 18% again? Maybe. But I believe for sure double digits. So, is there going to be a recession? Probably. The definition of a recession is 2 quarters in a row with negative gross domestic product growth. And we've already had that. Wait for the midterm elections to pass and it will probably be officially confirmed. The Fed has told us it's better for the Fed to hurt the economy too much and then try to heal it later than to relent in its campaign against inflation. This indicates to me that they would be willing to create a recession to defeat inflation. And if that means bringing the housing industry down, so be it. They've been true to their word in everything so far. Believe them. So if you are in the business that serves the housing construction industry or is affected by interest rates or a recession, you better get ready for a bumpy ride. So what do you do now? Thinking about selling and are waiting for the peak? Well, I'm sorry to tell you, but that was back about June. But it's still a good time to sell, and it probably won't be this good again for several years. Thinking about buying and don't know whether to buy now or to wait for prices to fall? Well, the best time to have bought was back in January. But the good news is now is the second best time to buy. To buy at today's interest rates before it goes to double digits. You will pay less in the long term if you buy now at today's rates than if you wait for prices to come down and buy at a higher mortgage rate. Hard to believe? Well, prices will be coming down because of the rates going up, and I can show you the math. Then later when rates come down, you can refinance. I'm Tom Ball, your local realtor with World Impact Real Estate. Call me if you have any questions or if I can help.